In Investing 101, Bill Ulivieri joins me now. He's a principal with Senecal Capital, here to talk about the price to earnings ratio. Good to have you on the show.
Thanks, Angela. Great to be here.
Let's just break it down. What does price to earnings ratio mean?
Well, the price to earnings ratio is a simple mathematical formula where you take the price of an index and divide it by either its previous 12 months of earnings or its future 12 months in earnings in order to get a gauge of whether the stock market is overvalued or undervalued.
So let's just give a real life example, taking the S&P 500. What do you see?
Well, the S&P 500 is roughly at 2,100. That's the current value. But that number itself really is meaningless. It only helps if you can take it into the context of something else to help the investor. So if you take 2,100 and divide it by roughly 86 is the dollars per share of the S&P 500, you get a PE ratio of around 24.5, which honestly in our lifetime is probably on the high end of the range, somewhere between, the PE ratio generally ranges between 15 and 27, so we're a little bit on the high end of the range. But again, it's just one of many tools that an investor can use to decide whether they should be placing money or not.
So when you see it and you're talking about the high end of the range, what does that signal to traders or professionals like yourself?
Well, that for every dollar of stock that we buy, we're paying a little bit too much for it. We want value. You know, institutional investors want value, as does individual retail clients. So we saw many examples in 2001 and 2002, also in the mortgage, the Great Recession we had in 08 and 09, that when investors get a little too exuberant about the stocks that they buy, they have to remember that it comes with the price, and you're taking a little bit, potentially too much risk there. So we want to make sure that we buy in the middle of the range, where we put as many attributes in our favor.
What do you do if you do buy a stock at a level that is too high based on the price to earnings ratio? Do you hold on to it or get out of it? What do you do?
Well, another way, Angela, of looking at it is if you invert the price earnings ratio and you do earnings divided by price, that also gives you a value which you can compare to the U.S. 10-year Treasury rate, which is considered the risk-free rate for investors. So for example, the S&P 500 currently has a earnings yield of around 4%, which is still more than almost 2.5 times the 10-year Treasury. So in terms of trying to make a decision whether you should be in bonds or stocks, you have to look at, again, the relationship between these numbers and not just the index value itself.
That is really fascinating, because I think a lot of people do wonder, should I put my money in the bond market right now? Should I put the money in stocks? But you're basically telling us that your money will yield more in the stock market.
Yes, and it's been that way for a number of years. And again, it's just one tool along with like little signposts along the road to help an investor decide whether or not it's a good time to invest and how much money they may want to commit today.
Well, good to have you on the show. Come
Thanks,
back,
Angela.
please.
It's great
Thank
to be
you.
back.